Hi guys, I'm back to one of our Trader Blueprint videos, and I'm your host, Mr. Merchant. In today's call, we're going to be discussing mindset, and it will be a psychology call. But as we go through the definitions, you'll understand why I'm naming it a mindset call and not a psychology call. Okay, so before we jump in, mindset is what we focus on. It's the thing that we aim to improve. Psychology is not what you focus on, because you cannot change the psychological factors that affect you during trading. So let's get some basic definitions down first and talk about some of the things that are really important to us as traders. And last but not least, I want you to think about this not like a lecture, but more like a conversation. We're sitting down, we're talking about real life trading experiences, real life solutions that can impact our trading, and real life problems that almost every trader experiences on this journey. So let's jump in and create a framework to build a conversation on. So the first thing I want to start off with is a definition of mindset, because we talk about the trader's mindset quite a lot. The term mindset, by itself encompasses a set of deeply ingrained attitudes and assumptions that usually influence how individuals perceive and interpret the world around them in order to both approach challenges and find opportunities, as well as create plans around the things that they want to take on or the tasks they want to accomplish. So, that definition, nothing in that says anything about psychology, if you know what psychology is. We leave psychology for later and just focus on the mindset portion of it now. So if that's our definition of mindset, the trader's mindset would refer to the specific attitudes, beliefs, and mental frameworks that are essential for success in trading, quite simply. So while trading involves analyzing charts, interpreting data, and making informed decisions in real time, at the end of the day, over a period of time, it comes down to the mindset of the trader that ultimately determines their ability to execute effectively and consistently. I want to listen to that part again. The mindset that ultimately determines the ability of the trader to execute decisions and consistently. Nothing inside mindset relates to skill. Nothing inside mindset relates to knowledge. We know knowledge and skill are both needed to be successful in trading. So if right now I'm saying, in order for you to use that ability or use the knowledge and the skill that you have and execute effectively, you need mindset. What I mean from that is anybody can create a plan. Anybody. It doesn't take so much thought to create a plan. But sticking to the plan that, you know, may determine the success of the plan. In the same way, when we all started, we would get an Excel sheet and look at um, the insane account flips, how to grow your account from, depending on how aggressive you are, sometimes $5, $10, 100 or 1,000, all the way up to millions. And the Excel sheet by itself is flawless in every aspect. It's a plan that has clear rules, no external influence, just absolutely perfect and flawless delivery, and no losing trades, which is the one factor that we sometimes don't include. So while the result is achievable, the realistic aspect of achieving that goal is time, as well as the conditions under which you're trading. So if you treat each part of that Excel sheet as a phase or a mile marker, you'll find that at some point going through the Excel sheet, you'll realize I don't actually need to start from zero to get to 100. I don't need to subject myself to unrealistic, extremely precise trading. Because if the Excel sheet says get start from $5 and take it all the way to 5 million, but realistically, my circumstances suggest that I could start with $10,000. Just scroll down to the sheet, wherever the balance is 10,000, and start pushing from there. That's realistic. That's mindset. That's taking what you know and applying it to be effective. Okay, some more mindset. So when we talk about mindset, in particular the trading mindset, comparisons will arise. Trading is not the only profession in the world that could make you wealthy. Trading is not the only profession in the world that requires a sound mindset. So what makes a trading mindset any different from a doctor's mindset, surgeon's mindset of an engineer, mindset of somebody in college? Well, the main difference is that there are unique challenges and demands of the trading environment. And it requires a combination of emotional resilience, discipline, adaptability or flexibility, and risk management skills to all work together, keep a trader grounded, not successful, grounded. Because when you're grounded, you can think. No part of success says you have to think properly. But if you are grounded, you can think. It doesn't matter what's happening around you. It doesn't matter the things that are happening or the things that you have to do. If you are grounded, you can think. In this dark world, being grounded is the eyes that you can use to see the light at the end of the tunnel. So the difference between trading mindset and any other mindset is that as traders, we must be able to handle psychological pressure. And these come in many different shapes and forms. Some of them are a part of us. Some of them are deeply rooted in your personality. So trying to fight against your personality in the name of I have to have a strong psychology. That's not going to work. It's madness. So if you're in an environment where every day you're subjected to the psychological pressures that come from dealing with inherent uncertainty in the market volatility, and the greatest fear of them all, the risk of losing money, then we need to maintain composure in the face of every single fluctuation and uncertainty that arises on a daily basis. As a trader, your mindset should help you maintain the composure you need to avoid mistakes like succumbing to natural emotions that will come up, and these could possibly cloud your judgment. When you're winning and you feel invincible, you have to be composed enough to say, I have made enough, I can stop here. I've done enough, I can stop here. I won't compare my results to others, I can stop here. I am paid, I can stop here. Like the law of power. In victory, know when to stop. But so often we don't have the mindset to stop. Everything telling you that you should go in, read, that extra bill you need to pay, anything else you need to do. Those are all the psychological pressures that form or manifest in different shapes that you have to deal with. And so often we treat them like surprises. Like, oh, I never knew that this was going to happen. Of course you did. You knew that this was going to happen. You know that if you make your monthly salary in one day, you're going to get excited. So what do you do about it? Well, I don't know. It's not going to happen to me. I'm not greedy. We're all greedy. So pretending like a problem doesn't exist simply because we feel different about it does not change the fact that that problem will influence you. If you don't think about it today, it's been happening to traders long before we started. We're not exempted to this rule. It will happen. But we don't have to suffer the same fate as traders who came before us because we can plan. So to wrap up mindset and the definition that we need to go forward, I want to leave you with the trading mindset encompasses the unique psychological and emotional attributes necessary for success in trading. How you prepare for all of these problems that are tailor-made for traders. And we don't know who made them, right? But because the problems are tailor-made to traders, you have to think about it from a trading perspective, a realistic trading perspective. And once you get that mindset, you'll realize that it's not as strange as everybody makes it seem. It's not as big and hard to tackle. It simply involves cultivating the right mental attitude, you know, and this is what is going to help you to navigate different complexities in the financial markets while still staying composed enough to make informed, rational decisions that align your goals. One of the first things that we should aim to do when trading is to supplement our income. If we're working now and you plan to be a full-time trader, or if you don't plan to be a full-time trader, one of your first goals is to have trading supplementing your income. If you could make half, quarter, all of your income from trading, you're successful. You don't have to be making astronomical figures or numbers that are out of this world to consider yourself profitable. If every month you only make $100, you're in the 5% of traders who make money. But comparison is what is going to have you thinking, no, I'm not. Your reaction to your own results is what's going to have you thinking otherwise. And that's where mindset comes in. Your result and how you feel about it is a normal psychological pressure. Everybody's posted making a certain number, percentage, but you don't see that. So you start to feel like you don't put out enough effort. You don't do enough. What are they doing that you're not doing? Your rules are saying don't go in the market until a particular time, but somebody else is in the market before you and they're doing well. So why should you stick to the rules? That's a normal psychological pressure. Mindset is how do you react to that? How do I react to somebody breaking a rule I hold for myself? If I have a rule that says any trades between 8:15 and 9 o'clock, I should put 0.5% on, and somebody is trading within the same time window, and they put 10% on, they do astronomical numbers, and I do enough to get by. I have to be strong enough to say, your rules suit you and your personality. My rules protect me from me and my personality. See the difference there? My rules protect me from myself because as humans, we are inherently greedy. Psychological pressures are always going to be here. Mindset is how, I'm saying this so many times, mindset is how we react to psychological pressures. Okay? We have to find that point where you're in balance. You're not emotionless, you're not a robot. We understand algorithmic theory, but we are humans. So we have to find that balance that says, I execute flawlessly in this manner. If I get either of these results, this one or this one, this is how I'm going to react. This is how I should react. This is how I'm going to protect this result. Who wants to protect a losing trade? I do. Why would you want to protect a losing trade? I don't want that trade to grow up. I don't want that losing trade to grow up and be a big trade I can't manage. So you keep it small, keep it tucked away, find the rules that say this is okay. When it's this big or this percentage, it's fine. Long-term goal, you're trying to align your mindset with staying in line with a long-term goal. Along the way, there are going to be many little things that come up. Small wins, big wins, small losses, break even. And as much as we can avoid them, we want to avoid big losses. And this is something that we all know. We all understand. We all understand how to analyze. We all understand what on a chart is significant. We understand how to engage. We have a foolproof approach that says within this window of time, a setup will form. It will form. But we are only going to execute on confirmed setups. We don't have an idea, and there's nothing on the chart that confirms time to go in or pull the trigger. There are aggressive confirmed entries, and there are confirmed setups that perfect. No extra risk here. It's normal, by the book, textbook execution. Love those. Absolutely perfect. But as you develop, as you become more inclined to seeing confirmed setups, as you study what confirmed setups look like, you will start recognizing early entries. That's fine. The ability to recognize early entries does not mean you're going to be a better trader. Because somebody identified a setup way before you got confirmation and they got a better entry than you, does not make them a better trader. Early entries is not about skill. Early entries is about accepting risk. So while on a confirmed setup, I am likely to put more risk on an early entry setup, it's more about getting something to pay myself. If I get an early entry before an order block or a setup is confirmed, and that early entry allows me to scalp something, took confirmation, and then add sufficient size on confirmation, and that's more money. It's not more skill. More skill does not get you there. It's accepting risk that gets you there. Now, not every early entry plays out. Some early entries are risky, meaning this is a setup that whenever it's not confirmed, there's a high possibility it's going to fail. Or it's just aggressive because once you don't get confirmation, you're entering and exposing yourself to risk. So on one hand, you have the early entries. On the other hand, you have the confirmed entries. Inside the early entries, you have extremely aggressive entries, the ones that look pretty close to what you see or pretty close to what you want to see. So you decide to accept risk on those. Perfectly fine. If you are okay with the risk, perfectly fine. There is no risk without reward. Every opportunity is a risk. If you're okay accepting risk, if you're okay taking this trade here, reduce the size because of the risk. If it loses, okay, cool. I didn't lose my account. It's business as usual, just took a loss. Then you can play early entries. If you look at the early entry and you're like, the possibility of this going against me is pretty great. So that's not a risk I want to accept. I leave that alone. All of this is still mindset. Whether the entry is confirmed or not, whether the risk on the setup is great or not, those are all psychological factors. What you do when exposed to those psychological factors, that is mindset. If your mindset says do not execute on setups that are not confirmed because they're subpar, that's fine. But most often, we accept that the setup is subpar until it plays out. Then you justify a subpar setup being high quality in hindsight. There is no confirmation, there is no retracement to the order block. Price pushes 30 points without you. What could I have done to see this? Could I have switched time frames? That's not mindset. Well, it is mindset, but that's bad mindset. That's succumbing to the psychological pressure. The psychological pressure of missing something that looks like a good move. Until you can sit at the chart, watch the candles breathe, watch them move, watch how price is delivered from one objective to another objective over and over until you start seeing the relationship between the deliveries. You're likely going to start feeling some type of way when you miss setups. Unconfirmed setups that play out should not affect you. But we're here to make money. We're here to do this every day. We're day traders. So what? What are you justifying? Why are you justifying? Why is missing a move so painful that you decide to go chase it? Who said to you, if you outline this, you see it likely to play out, and you enter and take a loss, and it moves without you, you're a failure? Who said that? Nobody said that to you. You attributed that to yourself. If I didn't get in the move, I did something wrong. No. If I missed the move, I did something wrong. If I didn't wake up early enough to catch it, and at 8:15 I don't get the entry, I did something wrong. That's not true. That is not true. And you have to know that. I cannot tell you that it's not true. You have to know that it's not true. Rules of engagement, rules of the game. The game we play has rules. The most important rule after identifying the drawn liquidity is determining the quality of a setup. Let's talk about that. What determines if a setup is high probability? What determines if a setup is low probability? Can a low probability setup yield a lot of points? Can a high probability setup yield small number of points? Of course they can. So why do we attribute everything likely or high probability to wonderful returns, This trade is higher probability because it ran 150 points. This trade is lower probability because it only ran 15 points. Where did that mindset come from? Where did that thought process come from? Self-imposed. The definitions of everything we do is what keeps us in check. It's the reason I can stay calm under most circumstances. Psychological pressures still affect me. They still tickle me. But my mindset, what I do when these things happen, what I do when I feel tickled, that's what keeps me from spiraling, keeps me from making mistakes I made 10 times before, keeps me from blowing up. That's what we all want. That's what we should all want. Trading is a war, not a battle one day. It's not something that you go in and you win every day. But you know that it's not something that one day determines the rest of your entire career. So why do you carry that around? Don't. Start with definitions. You know what the definition of your drawn liquidity is. Liquidity or imbalance. Simple. The definition of your drawn liquidity is liquidity or imbalance. Full stop. All you have to do is determine the likelihood or the probability of reaching for that drawn liquidity. We could mark out multiple highs and multiple lows. How do you determine which one is likely to be traded to? Failure swings, if this is an area of untapped liquidity, if this is an area where orders would come in the market. That's how you determine it. That's how you determine your drawn liquidity. But determine the probability of a setup. That part where probability is concerned will be subjective. That's the part where you have to outline the conditions under which you are going to engage. That's where your rules kick in. So defining the probability of a setup should come from you being able to check what price is doing now and confirming if it's in line with what it should do. If the market is bullish and it's consolidating, what should it do next? If the market is bullish and it's going up, what should it do next? And if you know what it should do, that's a potential delivery. And every delivery has an objective. So it all comes into play by identifying what it should do next, identifying where it should do it, and stalking confirmations right there. Overnight session, for example. If order flow is bullish, we're looking for a price to trade higher. The first thing you're looking for is what should price do next? Doesn't matter what it's doing now. We're looking at what should it do next. If it should retrace because there are imbalances, identify the imbalance and wait. If it should reject this level because it's a rejection block, identify the rejection block and wait. If it should create an order block here and then push, and you've already gotten that here identified, all you have to do is wait. The waiting process or within the waiting process, there are many things that can come up, many things that you can do. You could identify a setup as price trades to where it should be, and then wait for a change in the state of delivery. Those are the classic buy or sell moments. But so many times we go to the chart and it's doing something and we want to react. No. This candle is a big green candle pushing. Candle just opened. No idea if this candle is likely to be a bull candle or a bear candle. But it's doing something now, so let me react to it. No if this then that approach. Just a hit or miss approach. It's going up, I'm gonna buy. Went down, I'm gonna sell. And it's one of the things that I have to really thank ICT for, because when he said it's scary buying into a down candle, scary selling into a up candle. And at first you think about it and like crazy. When you hear it, it sounds crazy. The candle is going down, why would I buy? That's absolutely crazy. But then you see execution videos, not just ICT, but other traders executing. And you realize that there is a difference to how we interpret the market. And if they can do it, you can do it. That's it. You start outlining. I'll enter when it does this. I'll enter if it does this. I'll enter after it does this. And you realize that if this, then that approach just automatically develops for you. If it does this, I'll enter. If it does that, I'll enter. If it doesn't, I'll continue watching. What if you're watching and it's moving in the direction you expected it to? Then you don't do anything. You don't do anything unless something forms that fits a if this, then that approach. You can enter late without chasing price. If price has started to move and your ideal entry doesn't look like it's going to form, you can decide to allow this one to pass. Allow that one to pass. That's it. Or you can say, if it continues without retracing, I'm going to look for entry around about here. And you stock your entries there. So you're still stalking a delivery fractal within a move that's already started. Versus, oops, it's starting to sell. Let me just push the button here and hold. That's usually when price pulls back on you. And then you're faced to confront your rules. Why did I do that? I know that was going to happen. I know that was likely to happen. Why am I rushing to do something? Those are the questions that we ask ourselves. So when framing the probability of a setup and trying to apply your if this then that approach, always remember that if you're a trader reacting to price or reacting to what price is doing now, you're very likely chasing price because you wouldn't have given yourself enough time to see what it's doing, then react. Now, this doesn't require any skill. Again, there are persons who understand and accept risk. This market is bearish, pushing above this high. It's not likely to continue going up. I'm going to take the risk here. Enter, hold, beautiful trade plays out. You attribute that to skill. That's not skill, that's accepting risk. Accepting risk is not a skill. Accepting risk is a mindset. Think about it. If your mindset is how you react to external influences and prices trade now of a high, no confirmation, simply a feeling. That's you creating a plan in your mind that says, if it does this, I'll accept the risk. Push the button. Picking tops. So many persons can pick tops every now and then and get it right. Some persons can do it quite often. At the core of persons who are that aggressive is a clear understanding of when to accept risk and when not to accept risk. Persons who usually trade at aggressive, they build into positions. They don't put everything there at once. The traders who do that and put everything at once are usually the ones who hit and miss over a long period of time. Not today, not yesterday, not tomorrow, over a period of time. So when determining the probability of a setup, clearly understand that this is what it's doing now. This is what it should do next. I'm going to focus on what it should do next. And then enter. You start making it easy to identify high probability versus low probability. And the high probability setup is any setup that closely matches what your textbook setup or textbook delivery looks like. So if you don't have a perfect scenario, a perfect setup, a perfect trade, then you have work to do. Because when you know what your perfect trade looks like, you can decide if this trade, or you can decide quite confidently, rather, if this trade is one that requires you to size up, one that requires you to push the button, or is this trade pretty close to your A plus setup? So I'm going to reduce the risk. Instead of putting full risk, I put 3/4 of the full risk, half of the full risk, a quarter of the full risk, half of a quarter of the full risk. Because when you know your A plus setup, it usually can be broken down into phases, stages, or steps. It does this, and then that, and then that, then it runs. So seeing it enough times, you can understand each phase, each stage, or each step. What if there is a change in the order of your A plus setup? That change in itself can be the A plus setup for another delivery. So if it happens perfectly in step 1, 2, 3, 4, I put 10% risk on. If it happens in stage 1, 3, 2, 4, I put half a percent risk on. If it happens anything outside of that, I cut the risk dramatically. So now I have two A plus setups. One that does this, one that does that, and I manage the risk around them. I don't put equal risk on them both. Maybe for one of them, I build into the position instead of going in all at once. So quarter percent, build into a 3% risk or something like that. You don't second guess a high probability setup. You have to get to the point where you know the setup and understand it. So once it forms, the moment it forms, you click. And if that means something distorted happens that has price holding at your entry for whatever reason, your job is not to overthink that. Your job is to execute once it forms and manage your risk. Manage the position as it forms, manage the position as it moves, and that's it. You have to step away from being so attached to a trade idea, it paralyzes you. It should do this. You understand it should do that, and you just freeze. You're unwilling to accept close proximity entries because you're thinking, I need a perfect trade. Even if it's high probability, you don't need a perfect trade. You just need the steps to align. If you want an entry at a 50% of a OB and price is trading towards it, pretty close. Unless you're using a limit when you just have to be mechanical, put half a risk in. You could put half a risk in just below your actual position. See how it reacts there. Your analysis has to be perfect. Your execution doesn't have to be. It's trading towards the OB 50%. First entry. That's one. See if these confirm it snaps back and start to push. Enter. 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 Let it run. You get comfortable pushing the button mechanically until you get comfortable pushing the button mechanically with size. The natural progression. But if you try to put big size on every setup, it's not going to work. It's going to cripple you if you get it wrong. Which brings us to low probability setups. If you clearly understand what makes a setup high probability, forming the ideal time of the day, the structure is ideal, the order of delivery is ideal. Anytime something is low probability, you can see it before it prints, before the delivery is complete. This is low probability. Let me leave it alone. Low probability can mean it's happening outside the ideal time. The structure is off. Low probability can mean the candle is so big that you don't trust putting a risk on it. All of that is good because it says you know what you want to see before you accept risk. So while there are low probability setups, if they're forming inside delivery fractals that you consider to be highly probable, cut the risk. You either leave them alone or you cut the risk. Which means if you cut the risk and you win, it builds your confidence in executing mechanically. If you cut the risk and you lose, it builds your confidence in your rules that tell you when to reduce risk. And that should build how you engage with the market going forward. It builds your risk tolerance. Risk tolerance is different for everyone. Just like risk management, there are realistic approaches to risk management, and then there are not realistic approaches to risk management. Realistic approaches to risk management is understanding that if I'm trading an account of a particular size and I want to see a certain type of return, my risk has to fit a particular structure. I can't be flipping a $100 account and risking 1% per trade if I want to do this in 1 month. Crazy. I can't be trading a $1 million account, but I'm so used to risking $1,000 per trade that that's all I want to do here. Risk $1,000 per trade and take 2 trades per week because the account is big, so I shouldn't overtrade. Those are unrealistic expectations that we place on ourselves because we try to emulate people who talk about these things. 95% of traders fail. And within the 5% of traders that are successful, I wouldn't be surprised if 50 or more percent of those are break even. They're not winning, they're not losing a lot, but they're just at that point. They have great skill, absolutely perfect, flawless skill, understanding flawless. When it comes to pushing the button, they second guess themselves. They spiral when they lose. They Hail Mary a lot. You know what I mean? That trader you put on for a larger size simply because you took a losing trade before, then it started to run. You thought that this was going to be the one. That's a Hail Mary trade. When you lost 2% from 3 consecutive losses, and then your fourth trade, you put full 2% risk on, and the market runs quickly and make it all back, and you close everything. That's a Hail Mary. All of those attribute to or contribute to your risk tolerance. Most persons become numb after a while. This is the game we play. Most persons become numb. You lose so much so often that it's whatever at this point. It doesn't have to be. It doesn't have to be if you've blown an account 10 times, right? Let's say 10 times. And every time you blow your account, it's because you had a correct idea. You took a few losing trades, let's say 2 or 3 losing trades. The market wasn't moving, so you just decided to pray. Just enter and pray. This has to move. I'm just going to enter here, hold it. I'm going to put a lot of size on. I can withstand drawdown. And then the market probably spikes against you really, really far. Or the market just does something really, really fast. And that crushes you because right after it did that spike, it tanks. Right after that. And you lose a big chunk of your account. You got margin called. You had a really wide stop because you factored in a potential spike. So now the move was started to fall fast. And because you lost such a big chunk of your account, you cannot enter again with the same size. You have to enter with a smaller size. With a smaller size, the trade played out and you only got a quarter of what you lost. your mind starts to think about this is not enough. You need to do something else. And the sad part about it is you're telling yourself you have to do it now. Do you know how many days in my journey I have closed the day in red simply because I was afraid of myself? My analysis is on point. I don't have a problem executing mechanically, but I know that if I get so focused on a 1 minute chart, I'm going to see a lot. And if I see a lot, I'm going to do a lot. And that could mean a bigger loss for the day, turning it all around, or ending at break even. But how often do we go back right now? How often do we let that loss simmer for a moment, come back an hour later? How often do we just end, then come back? Or how often do you force it? Market's in a tight range. You took two losses. It's not moving. Everything that looks like a setup, snapping on. Because you're just snapping on whatever you see, and the market hasn't shown you willingness to move. Small little wiggles and waggles, small profit, small loss. It's just fluctuating or oscillating between those two levels. It's like your entry is a zero line, and the market is just going above and below it. You get frustrated, or you get hopeful. You add more zero lines, you add in resistance. Then the market just spikes up out of nowhere. And you're like, how do I read this wrong? How is it that I read this so wrong? Hans, your risk tolerance is too high. You've become too numb to the reality that the market will take everything from you if you allow it. Mercilessly. It will take everything you put in the account, everything you made yesterday, everything you've made since morning. And if you put more in, it will take it again. But only if you allow it. That's the only thing we have control over. Some amount of control. How much the market can take from us. So, mindset, a big part of mindset is understanding when to not give the market anything, when to give the market how much you want to give it, when to put your account down and take up a different account. That's mindset. No ego involved, just protecting yourself from yourself. You have a beautiful analysis, but you've done really well for the week. Really, really well. And you're at the point where the setup looks beautiful. So you know if you go in the market, what you're going to be risking profit. You're going to be risking profits, make more profit. And that's perfectly fine. But do you have to? Have you met your goal for the week? Your goal for the day? Your goal for the month? What happens if you analyze this move and you didn't take it? You decided to sit this one out because you didn't need to. Nothing. Doesn't take away anything from you. Not a thing. Your mindset has to be at that place where I can do this over and over and over. Every month, we're doing the same thing. If this one doesn't play out, that's fine. If you outline exactly what you want, doesn't happen, that's fine. In trading, one thing we know, there are many different strategies that work. Some of them overlap, give you the same entry. Some of them don't overlap, but still give you an entry. But the one skill or strategy that's consistent is how to stay out of the market. And while there are many courses, paid and free, staying out is free, full stop. You don't need to pay anyone to stay out of the market. But in the words of a wise trader, strategies that get you in the market are a dime a dozen. Skill to stay out of the market is free. It often costs the most because you don't pay money to stay out. Discipline. Discipline, the cost of staying out is discipline. There's no price on that. There's no price on discipline. But for mindset, or for the mindset portion of today's lecture, there's only one thing you should keep in mind. Trading mindset is how I react to whatever is happening. If I'm right, how do I react? If I'm wrong, how do I react? If I can't see what the market is doing, how do I react? If it's crystal clear and my analysis is flawless, how do I react? That's mindset. If I have a bias and everybody's biased against mine, how do I react? That's mindset. If I just got an email about non-trading things that tickle me mentally, but I'm at the charts now, mindset is how do you react? Do I get up and say, um, this is throwing me off my game. I don't feel like I'm performing at my optimal. I don't feel like I'm in flow state. I walk away here, I come back. That's mindset. Do I end my day early here? I haven't taken any trades. I've done an hour of analysis. Some bad news just crept into my mental space. Do I try to escape that bad feeling by jumping in a trade, trying to get some type of validation or a little hug from the market? Or do I just leave, come back tomorrow? Is it something that's so psychologically taxing that I need to take the rest of the month off, the rest of the week off? And can I stay out of the market because I need to? How many persons do you know take a couple of days off and come back with clarity? That's it. So with that, we move into trading psychology and journaling. So let's say you've been trading for any amount of time. Trading psychology, in particular, Mark Douglas trading psychology is the most popular trading psychology reference tool out there. Everybody who's traded has heard about the Mark Douglas book, and I've never read it in its entirety. I've never read that book in its entirety. Not to say anything is bad about the book, not to say I wouldn't read it, simply to say I've never placed a great deal of importance on it because I learned trading psychology from a real person, a real trader who trades live, decent size, taught me trading psychology. He taught me the difference between trading psychology and trader's psychology. Trader's psychology is what I've now figured out or realized is just mindset. Trader's psychology is mindset. Trading psychology is just what we're about to discuss. So, to appreciate this portion of the lesson, you're going to have to think before today, whenever you heard the terms trading mindset or trading psychology, you probably put them together and think that they were the same thing. Pretty sure. But even if you've never thought about it, that there's a difference between trading mindset and trading psychology, at some point in your career, you would have either listened to somebody talk about the importance of trading psychology, or you have had that conversation about it. So since we're all familiar with it, let's talk about it. So if you've never considered that trading psychology and trading mindset is different, from this lesson or this conversation, you should now be aware that there is a distinct difference between trading psychology and the mindset. Trading psychology or psychology refers specifically to the factors that influences traders' decisions, their decision-making process, their behaviors, and how they think in the markets. The entire goal of trading psychology is to explore the topics that affect us most. Emotions, greed, fear, hope, and regret, your overconfidence, your loss aversion, and any psychological bias or anything that you hold in high regard as it relates to trading. For example, the belief that when you get to a chart, the first thing you should mark up is PDR is. That's psychology. So any type of bias that can lead to you performing suboptimally or making not the best decision in trading psychology encompasses all that. So mindset, or the mindset that we're going to discuss once we understand trading psychology, is how to identify and manage these factors to enhance your trading performance. Okay, so now that we've covered both psychology and mindset, and on one hand we have the things that impact us, and on the other hand we have how we react to these things, you should now be able to effectively create a plan, fix your mindset, not your psychology. You can't fix psychology. You just have to be aware of psychology, or be aware of the psychological factors that affect you. So each person needs to sit and think about What makes you do something? For some people, it could be because I said it, because I said something is happening. You make a plan around that. Some persons, it's what you understand. I understand this rule. So this is the rule that has me looking at the market through a particular lens. Once you can identify the things, you could list them out so you don't overthink. The more you list out things from your mind, the more clarity you have. So you list them out, you look at all the things that impact you, then you create a plan for how am I going to interact or how am I going to manage these things, not have them manage me. Once you've done that, you'll realize that all the factors that you need fix, you already know them and you know how to fix them. You do. You know how to fix them, but you just don't have the will. Stick with it. If you blow an account one time because you used, um, let's say a lot size that was too big for the account, and you top up the account again, and you start using the same lot size because you won your first couple trades, that's something that's affecting you, your psychology. That's something that's creeping into your space, and you need to fix it. Sometimes fixing these psychological factors are as simple as saying, even though I have 5 days to do this challenge, I'm going to do it in 10. I'm going to plan to do it in 10. So you find that the need to size up on every move starts to move away. And as that need starts to move away, you get more aware. You look at the charts and you start thinking, oh, I don't have to do this. I don't have to put even though this looks like a really good setup, I'm training my mind. So I'm intentionally putting less risk on to train my mind to accept that we're not going to rush this process. Then price gets there, they're good. Let me ask you a question, right? This should be funny. If you have a plan, trade plan, that says in 10 days, I'm going to make 1% per day, risking 0.5%. And for whatever reason, all your trades are framed at maximum 2%. So you want 1% per day, but when you put your stops and your take profit in, your take profit is at 2%. Let's say every day in the first 5 days, price runs to TP quickly. So you didn't get a chance to partials at 50, to secure 1% and then let the rest run. Price just runs quickly. Enter TP every day. First 5 days, you make 10%. In the second week, would you still trade? Would you still trade the extra 5 days? Or would you say that because you've hit the objective, no, I don't want to lose anything. I'm going to stop. I'm not going to give an answer for that. I want you to think about it. I want you to think about why you would choose each of them. If after making 10%, the second week, you still go in and trade, risking 0.5% to make, max 2%, but partially at 1%. If that's your decision, think about why. If your answer is, well, my goal was 10% and I made 10% in 1 week. For the second week, I'm just going to do nothing. I want you to think about why. That's your answer. If you want to share that with me, perfectly fine. If you want to keep it on journal for your own psychology, perfectly fine. But it's something I want you to think about, and it should tell you a little or a lot, depending on how much you think about it, about your own psychology. Okay? So now that we've gone through trading psychology, let's talk about the classifications. Most trading psychological factors can be grouped in one of three categories. It's either your emotion, your obligation, or your environment. Simple. The emotions are easy. Those are the main ones. The main elements of our psychology in terms of trading is your emotion. Because you need to understand how you feel when trading. Because very often how we feel impacts how we think. And how we think impacts the actions we take. So it's 8:15. You open your chart, you're doing your analysis. How do you feel? Your analysis is done, you're waiting for equities open. How do you feel? Equities open as past, your entry is setting up. How do you feel now? You've gotten your entry, price is moving. How do you feel now? Confronting those emotions are very important. Very, very important. Because they can point you to your triggers. And if you know your triggers, you could start creating a plan for long-term success. Some persons are still of the belief that you can cut your emotions out, put them in a box. That doesn't help. So you're in a trade right now. You're winning. It's running 50 points. Your TP is 70 points. You're closing the phone to breathe, so you don't look at the P&L. Mandate effect. Or long-term goals or long-term trading objectives. You don't know what can happen when you close that phone screen and force yourself to walk away or force yourself to be disciplined. So you don't do that. Focus on the price action. Every delivery has an objective, and every delivery objective is traded to by a particular fractal. We don't know every fractal. Impossible. We can't know every fractal. But there are fractals that we understand. Those fractals are what you pay attention to. The analyst within you recognizes those fractals. The trader in you recognizes where to execute within those fractals. Once you stick to it like that, no reason to have emotions. No reason to fear if the analyst has done his job. The trader just needs to push the button. No fear. No need to be greedy. The analyst has done his job and you're just doing your job now as a trader. None of that. Okay? So, greed, hope, fear, and regret. Emotions in trading that govern us all. We can't get rid of them and only control them. We regret the decisions we don't take. We are greedy when they play out. We're fearful when it goes close to your stop. And you're hopeful when it goes pretty close to your stop or pretty close to your take profit. So be aware of your emotions. Be aware of how you feel. create a plan for how to react to these things. Right? So this thing is getting pretty long. I know psychology talks are not the most fun in trading, simply because we always want to learn the things that I can go look for on a chart tomorrow. And I like that. I like that. That's a good way to look at trading. Anything you learn from a conceptual standpoint, if I can't go to the chart tomorrow and see it, then I'm wasting my time with it. But what about when you're not at the chart? What about when you haven't gotten an entry as yet? What about when there's nothing to do? If you only know what to look for in a chart, and right now we're in a condition where there's nothing to do, and you go looking for stuff on a chart, you're going to find stuff. And if you don't have the courage to leave those alone, you're going to get cooked. The next thing that pulls on us while trading are your obligations. It's the next major factor that tugs your psychology. And we try to meet most of our objectives through trading gains, in the sense that if I make this money from trading, then I'll do this. So because you think about it like that, if you don't make money from trading, your next thought is, I won't be able to do this. I won't be able to afford this. This is going to happen. Sometimes those expectations are, or the obligations are, your plans. You're creating a plan, and that plan could be quit your job to cover living expenses, to pay off some type of debt, or just to supplement the income. When you're trading with those obligations, if they are high priority items, which means you want to get them done now, that desire to force the market to do something is going to really hurt you when the market does nothing. So you've done a plan that says, if I get 20 points every single day with this lot size, at the end of 6 months, I'll be able to do this. If I get funded, I'll be able to do this. Once that is the core part of your trading, it's going to pull away from what you should get from the experience, the trading experience. The only thing, single most important thing that we want from trading is understanding deliveries. That's it. We need to understand that every time the market moves, it's a delivery fractal. Not every fractal is going to be recognizable. Not every fractal is going to be familiar with us. So what we want to do is identify the fractals that are easy to see. If I can see it, I can trade it. Once I can see it and I understand it, then I can move into managing the risk around it. Profile one, I could simply look at plain only profile one's 0.5% risk every single day. Don't do anything unless overnight session is taken or 50 points is hit. Or I could say most overnight session is within 50 points or higher. There are cases when it's lower. I could aim for half of that, 3/4 of that. I could aim for 35 points every day. I could aim for, because I want to cover my living expenses and supplement my income. I'm not going to aim for 20 points. I'm going to aim for 25. I could say at 20 points, I'm going to take off 80%. That 80% that I took off is to put away to pay off a debt. And then the other 20%, that's for a trip somewhere you want to go. So anytime you get a trade, whatever you take off to cover the important stuff, whatever you leave on is to fund luxury or something, buy a watch. When you look at it through that lens, you realize that the obligation that tug on me, I can implement a plan for them in my trading to prevent it from being a burden. If you're currently managing your obligations to the T perfectly, paycheck to paycheck, and your trading income starts to develop, the first thing we try to do is just do everything at once. We don't need to. If I can focus on making half of my obligation per month, just half. We don't need to get full thing at once. Develop a plan to get half of it. You get breathing room. That breathing room is important. That breathing room is what gives you confidence. When you can sit and pull, let's say you have a car payment that's $1,000. Like, let's just say $1,000. Easy enough, easy math. And you can pull $500 from your trading account every month. You're covering half of your car payment. That extra $500, you can now use it to save, invest. If you have multiple payments, you could use that 500 you saved to cover something else. Maybe you have a lot of debt, big ones and small ones. Maybe you have a couple of $500 debt. Who knows? Every time you can save something by pulling from trading, you can get rid of one of those. Get rid of them until you get rid of them all. So when obligations pull at you in trading and you feel like you need to escape the world and hide in trading because nobody's knocking at your door when you're trading, nobody's nagging you when you're trading, it's going to create trading as a safe space. And if you stay in the market longer than you should, you know what happens. So you have to move with the flow of your own life. If obligations are leading you to making rash decisions, you want to stay away from trading for a while until you get that balance going. If obligations are not pulling on you and you have time, then that's when you can try to look for solutions. But you don't want to have your obligations at your ankle. And then you're trying to do this with your trading. Uphill battle. Something is pulling you down, something is pushing you down. You're caught in the middle. Psychologically, that's going to eat you up. The next thing where we see the most psychological pressure stemming from is the environment you're in. And this is one of the self-imposed psychological pressures that we all have. Self-imposed because in your environment, you expect things. In your comfort zone, you expect things. In your space, you expect things. And the first thing that we expect is support. You expect persons to understand that, hey, trading is very hard. And I see you trying. You have a good work. I saw that you just blew your account. Um, I can see that it was an accident. You really did the right analysis. It's not your fault. Here's some money. Put this back in your account. Just pay back when you can. You don't have to pay back right now. Take it easy. No rush. I believe in you. You want that. But most of the world does not look at trading with any kind of significance as they would do for like other professions. If you're going through med school and like, hey, I'm going through med school and I'm struggling now, what? Scholarship, loans, grants, readily available. You're going through law school, same thing, engineering, math, any other profession, or most other professions, it's easy to get some type of support on that journey. When you're going through trading and the going gets tough, you're alone. Even though most persons understand what Forex is. Because if you ask persons what's foreign exchange, they can tell you what the banks do. So the banks do it and they are still doing it. It must be lucrative. They must be making money because the banks exist solely to make money. So why don't you think I can be in the same business as the bank and make just as much money as the bank? Well, it's only you. Those guys went to school for finance and all that. But what did you do? What financial background do you have? So even if you don't have that conversation, most persons around or close to you, that's what they're thinking. You don't have the qualification for this. Everybody's failing this. It's a scam. Go get a job. You need to quit. How long have you been doing this? You know, where is the gains since you have done this? That can be demotivating. And depending on your circumstances, that demotivation has a greater effect. Like if you're in college, it's not a big a deal for you when you're in college because you're just trying to make some extra money. You know, parents are covering everything else. You're just trying to make some extra money. If you are probably single and trading, not a lot of persons' opinion will matter to you. You might not share this with a lot of persons. So if you do happen to share it and somebody says negative stuff, you can brush it off, depending on who it is. If you're in a relationship and your spouse says, hey, this trading thing that you're doing, not really seeing any gains from it. We need to cut back on expenses. We need to budget. You're likely going to commit to your responsibilities. So then the most unrealistic thing starts to happen. You start reducing what you put in, which could mean effort. Maybe your TradingView subscription, you're paying for TradingView, and you needed all the indicators on, analyze for some reason, right? But now you're cutting back. You cut out the indicators um, because you cut the indicators out and you were so used to them drawing things manually just doesn't sit well with you. So you start performing subpar analysis, your trading starts to probably go sideways. I mean, of course, it's possible that you could start seeing clearer from all of this, but most times, your effort starts to dwindle. One of the most one of the most emotional parts of my own trading was the fact that my environment or the persons I had in my environment, they knew about what trading could do. And if they didn't know, they heard what I said about it, you know. Because again, where I live, once I make money trading, I convert it to my local currency. So when I can say to someone that, hey, um, I just covered all these bills, all these expenses using this much money I made from trading. Like, you're making money. Wow. Everybody's happy for you. You're making money. And you're happy that they're happy for you. But nobody checks on you. Nobody checked on me. Nobody checked on me and said, how's your trading going? I can only recall one time, back probably 3, 4 years ago. Specifically remember it because I was in an oil trade and I was up. At the time, I was trying to make like $8 every day, and I was up $81. And getting ready for work, and my mom called me, and she was saying, "What's going on? Everything's okay?" And I'm like, "Yeah, I'm in a trade and all that." And I'm explaining to her what trading is and how much I want to make for the day. And she's like, How's the trade going now?" And I'm like, "That's $81." And she's like, "Since you're getting ready for work, why don't you just close it right there?" Like, okay, fine. And I closed it. And moments after I closed it and got ready for work, it did a complete reversal. And I called her and I said thank you, because if you hadn't have said that, I would have held and I wouldn't have made anything. So if you are someone dealing with an environment that's unsupportive, nobody believes in your trading, it doesn't stop you from being a good trader. What will stop you from being a good trader in an environment that's unsupportive is bottling everything in. When you have everything on your mind, all of the expectations, all the negative feedback, it's it's hard. It's really hard. Anytime you keep stuff in, whether it be bad days, bad experiences, again, unsupportive environment, it doesn't give you the closure you need to move on or move past it. So most traders hide their losses because of the relationship I want to develop with you guys and the community I'm trying to build. I I try to ask persons, don't be afraid to share with me. I don't have all the answers. I don't know everything, but because I didn't have a whole lot of help when I started my journey, I experienced almost everything or all of the bad sides from trading. Half my salary used to go into trading when I just started. Within the first 6 months, I was putting half my salary into my account plus paying for ICT. So that was a lot. It was a lot for me, and it was one of the reasons why, even though ICT was saying don't trade while learning, I found it difficult to take that advice. How am I going to invest this much from what I have and then just trust that 6 months or 12 months later, I'm going to start making it back? I felt like I wasn't doing enough for myself. I felt like it was my dream and my goal, and I was leaving it up to chance. That's how I felt. So I would put money in my account, pay for ICT, then from the money I put in my account, I would try to make something on it so I could pull back the original. So if I put $100 in, if I could get that to 150 or 200 at the end of Friday, I'm pulling it back. I could show you screenshots from 2019, 2020, where every single day I just pulled $50, just $50. Every day I pulled $50. And I didn't start with any kind of huge account. I was over trading like crazy. I've shared this before that in the past, I had days when I'd be taking over 100 trades, literally over 100 trades. Gold, GA, GN. I wasn't trading indices, AU, EU, everything. I just had a basket of currencies and I trade the correlation. If one is bullish, they should all be bullish. If this is bullish, this should be bearish. And whichever one is fastest one is the one I put more risk on. So if I bought a bullish pair and then another pair was bearish and the bearish pair was falling faster, I'm adding more sales to that. So I take a whole lot of trades and just pull $50 every single day. And I know that's not something that everybody could do or would do, but again, this was my goal. When ICT told me about his story and how he made a plan to retire and all of that, it was inspiring. I wanted to do the same thing. So I made my plan. I did what I had to do. But yeah, so just to wrap up the environment, this is what we expect from our environment in Jamaica, or maybe it's something that's said everywhere. There's this phrase that says, each one, each one. That's what I expected from trading communities. I expected to, back then I didn't know anything about Twitter and stuff like that. I was the big social media fan, not the brightest bulb. But when I got exposed to social media, and I have no ill intentions towards any other trader. I'm I'm coming into the space thinking everybody understand that this is a difficult game. Um, we're all trying to help each other. I wasn't a I wasn't against paying for anything because clearly I paid ICT. So when you start joining communities and persons start to say stuff like, all you need is the classic buy day, classic sell day, and showing examples, all that good stuff. You're like, yeah, I like it, I like it. Then persons would send charts that don't necessarily align with buy or sell day profiles. And just try to be mystical about it. And when they don't explain, you, as somebody who's eager to learn, you do the most logical thing. You grab their chart, you look at what time they entered, you reconstruct it on your own broker, and you try to figure out what they saw. I did that a lot, a whole lot, just looking for something. And there are times when I could reverse engineer what they were doing and got an idea. But in other times, it wouldn't make any sense to me. I'm like, I'm looking at this M5 chart that you shared, can't see why you entered. And when person would send like M15, like maybe they did it on another time frame. I would mark out their entries and just start cycling through time frames, form fitting why they got in. Eventually I stopped. Eventually I stopped because persons are just making it too hard. Too hard. I have a lot of videos from ICT to catch up on. I'm trying to reverse engineer all these charts. I'm not thinking at all. I'm just absorbing information, absorbing like a sponge, but I can't apply anything. So once I became aware that that was the problem, I just decided to review. I wasn't a big fan of review. ICT did a midweek and I think end of the week review. That was the only review that I would pay attention to. Once I stopped trying to absorb content and I started to review on my own, you start seeing things. You start realizing that, oh, this came back to this price. This did this at this time. This is what it looks like. And then the H1 chart became my friend. I started to see things across the H1 chart. I started to see how past and current week overlap in terms of key levels, like 50% of the previous week and all that. And it was around about that time I think I got introduced to algorithmic theory. And I guess the rest just kind of happened. But we detoured. So psychological factors that play from your environment are always going to be things that you can walk away from or things that you can reduce their impact, but you have to be willing to not bottle it up and pour it all out, maybe on paper. Literally, just if you have somebody, it's kind of fun. If you have somebody who is always talking bad about your trading, but out of respect, you don't um, say what's actually on your mind, and you have all that bottled up. If you have a journal, like, it's a good practice to just express yourself on paper. Whether you need to burn it afterwards or keep it, that's up to you. So if you have a brother who looks down on your trading, sometimes you just want to say stuff to him, grab a paper, say, listen, man, you don't understand. Just write it all out and feel how calm you become. Getting rid of all of that will fuel your drive to prove them wrong. And that drive to prove them wrong is what is going to force you to confront the things that you know are holding you back. So you know that you shouldn't be trading at this time. You know you shouldn't be doing this. You know that you suck at following rules. Whatever it is, you know what it is. And once you confront it, find something, to keep it together. And it could be something silly, but it's just for you. I have my watches for that reason. I have lots of things. I have a light that says, can't hear you, I'm trading. That reminds me when you're trading, you need to explain to the persons that care or the persons that are close to you that within this time, leave me alone. Just leave me alone. I love you to death, but leave me alone. Let me focus. If I reserve an hour every day to sit in silence and reflect on my life, I don't want you talking to me. Just allow me to ground myself. Once you get that momentum going, then you should be fine. So bring it all back to psychological factors and especially external psychological factors. You want to remember that there is no fix for psychological factors. Most of them you cannot stop. You cannot change somebody's opinion of what you're doing. You cannot stop yourself from being greedy, fearful, hopeful, or regretful. You cannot change your environment. You cannot. So, what you try to fix is your mindset. I'm greedy, but I'm going to do this. I'm fearful, but I'm going to do this. This is what they think of my trading, but I'm going to do this. That's it. So become aware of the things that trigger you. Become aware of what you do when you get triggered. Offload your thoughts and get out of your head. Take a mental dump. Clear your mind. Take time to reflect on yourself. You've made one mistake 5 times. You feel that mistake coming on right now. You feel yourself wanting to do the same exact thing that causes the mistake. Just stop. Stop. Don't pick the high. Wait for the CFD. There's no CFD in it runs. So what? So what? If Patreon hasn't taught us anything, it showed us that there are times when we sit for an hour and a half, don't get the setup. There's no rhyme or pattern to those. If there is no rhyme or pattern to those that you can fix, unless you're going to guess some stuff, then allow them to happen. Accept them as natural parts of your progress, your process. And on the days when it's all sunshines and rainbows, enjoy it. But offloading your thoughts and getting out of your head is very important. It's something that you should do. You should. You should express yourself so your bottled up thoughts don't change how you feel because that's going to change how you act. So when we talk about getting out of your head here, we're talking about trade journaling. And for those who don't know, journaling is a practice where traders document and record their trades, observations, and reflections on their trading activities. It involves maintaining a written or electronic log that captures important details and insights related to trades you executed in the market. Simple, right? So most persons say they don't journal. Most persons have been profitable for a while and they don't journal. So they don't see a need to journal. Why? I don't know. You're running a business. As a trader, you're in a business. Businesses have logs, receipts. So why shouldn't you? But I think most persons don't understand what to journal, and that's why they don't journal. Or most persons who do journal, they don't reread their journals, so its importance is diminished. Let's talk about some of the things that are included in trade journaling. So journaling should essentially be your message to establish the following, right? And that message is to yourself. How you track and review your trade performance, how you identify and adjust your trading strategy, how you manage emotional triggers, and how you enhance discipline and accountability. On this date, you said you would do this and only this. But on this date, you broke it. Why did you break it? It was something silly, and write it. I just felt whatever it is, just write it out. Right? Just get that out. Get out of your head. And that moves us into the next thing. If you're a trader that has achieved some amount of profitability without trading, then the importance of journaling is going to be hard to see. Again, after all, when has journaling ever helped you to take a trade? When did your journal tap you on the shoulder and say, hey, this is what you should do here? When did journaling ever help you in your trading, right? Most people are like, yeah, right? That's why I don't do it. Yeah, you get it. No, it's wrong. That is wrong. You have journaled. Even if you say you've never actually journaled, you have journaled. You've made mental journal entries of the most emotional points of your trading. You carry around mental entries of the fractals that have made you money. Even if you've never journaled what profile one looks like, in your mind, you know what it is. If you missed that entry because profile one didn't come back to the order block, you remember that. If you had early entries, if you missed early entries, if you had exit opportunities that you missed, all the setup that you took and you got stopped out when it looked textbook, you have those in your head. So why does your journal, if you have one, look like this? Blank, full of empty pages, right? Good question. If you have so much experience, you've been trading for so many years, why is your journal still empty? Why do you still have nothing to put in your journal? Simple answer. You want to believe that you don't know how to journal. You tell that to yourself. I don't journal because I don't know how to journal. I don't know what to journal. That's not true. Fact is, you don't want to get up from your trading desk and miss an opportunity while you're reviewing your journal. So you don't see the need to have a journal. You want information that you can access real time. Post-its, sticky notes, pop-up notifications. That's what you want. Nobody wants to get up to go check their trading journal and miss a setup that they've been stalking. That's the cold facts. But take a moment and think about this. Journaling and review should ideally be done when the market is closed or when you're not trading. You don't journal in lifetime. Why would you do that? It's crazy. You journal when the market is closed. For me, Saturday morning, Sunday morning, if I have something to do on Saturday. Some person journal the end of every day. Perfectly fine. If for any reason you're trading live and you feel the need to check your journal, it means something is happening on the chart that you don't know how to respond to. You're unsure about it. And if you are unsure about it, then there's no need to do anything. There's no need to do anything that you're unsure about. Wait for confirmation. If for whatever reason you know that there's an experience that you have journaled before that could help you right now, and you're currently unsure about the current market condition, go read your journal. Ignore this macro and trade the next one. Allow this one to pass. Okay? Now, overall, trade journaling is a valuable practice for traders at all levels of experience because it provides a systematic way to review and improve your trading performance, manage your emotions, refine your strategies, and cultivate your discipline. It's like going to the gym. Journaling is like going to the gym. Boring and annoying, sometimes painful, but once you get into the habit of doing it, it feels easier. You look forward to doing it. You look forward to those reps. That's it. By keeping a detailed record of your trades and reflection, you can make more data-driven decisions. I've seen this profile form twice every week for the last 6 weeks. Cool. I'm going to focus on this profile. And that's how you learn from your past experiences and continuously improve and grow. So, with that being said, reflection. Because we spend a whole lot of time feeling alone, I want you to think about your rules, not as, oh, these keep me out of the market or these keep me from doing stuff, but look at them as a promise to yourself. You promise that by sticking to your rules, you will only do the things that you know and understand. By sticking to your rules, you promise you will only trade according to the process you've created. By sticking to your rules, you're going to avoid delayed gratification. Well, you're going to focus on delayed gratification rather. Forget what it's doing now, focus on what it should do, execute if what it should do actually happens. You're going to focus on having a peace of mind because you execute according to a process, everything else gets pushed to the side. And lastly, because you execute according to a process, you're going to push the button whenever your rules say so. Nothing else. With that being said, that concludes our conversation for today. I do hope it was helpful and insightful. See you in the next one.